What is going on, traders? Welcome back to the Traveling Trader. So the choppiness that we saw in September continues in October. I recently came upon this article that's titled "The Most Dangerous Stock Market Ever." And I really want to take a deep dive into these metrics and analyze whether that's the case and what could be expected from the stock market upcoming. Are we going to crash some more? Is this going to turn into a correction? Is it going to turn into a bear market? Are we going to see a depression? I'm sure you've been reading a ton of different headlines all over the place, watching different YouTube videos, but we will disseminate the information in this article titled "The Most Dangerous Stock Market Ever." And then I'll be giving you my take, my analysis. So far, we've been generally right, especially with tracking trends like the September-October trend when I said that by September 17th, that's likely the date that you want to sell stocks if you are worried about the short term. So far, that looks like it's playing out. And I'll get into some of the stocks and moves that you can make in order to protect your portfolios against the choppiness and even more dire against the inflation risk. If you get anything out of this video, leave it a big fat thumbs up just like this. Welcome back to the Traveling Trader, your source for regular, non-BS, concise market updates. Let us get right into it. So this article was written by Ross Hendricks, who's an independent contributor to Seeking Alpha. And again, the title of the article is "The Most Dangerous Stock Market Ever." Why does he name it that? Well, the first point he states is that record margin debt is approaching $1 trillion. If you look at this chart here, speculators have taken out a record volume of margin in order to finance their stock purchases, mainly due to speculation. We are now almost at $1 trillion worth of margin debt, so far past the all-time high, which we saw back in 2018 when there was actually a correction as well. We also hit a peak in 2015 where there was a correction as well. There was the peak in 2008 where we saw a full-on bear market recession. And then obviously in 2000 where we also saw a full-on bear market recession. So we should not dismiss this entirely. There could be some truth to it. However, notice that this trend is sloping upwards anyway. So in general, you expect with more participants in the market and with the improvement in some of the technologies based around trading, you expect this to increase over time anyway. Throw in the fact that people have a lot more helicopter money now as well. But this is definitely a valid point of concern. He also points to a record surge in options volume, sometimes options volume surpassing that of the underlying stock, which is definitely a new trend and leads to a lot of some of the phenomenons that we've seen last year, such as the gamma squeeze in GME. Actually, that was this year, early this year. But the gamma squeezes that we saw in GME, as well as some other stocks, was due to the fact that we had options volume surpassing the trading volume of the underlying stock. Tesla was a part of this as well at different points in time. The next measure he looks at is total inflows into the stock market in 2021, saying that 2021 is unprecedented in terms of the amount of money that households have in the stock market. Now, again, it was also a record for stimulus money that cannot be separated from this phenomenon that we see here. Now, with all that said, his thesis is that the way this ends is when there's simply no more dry powder left to push prices higher. And technically that is true. And he says it is this type of environment that when inevitable corrections happen, those small declines could eventually snowball into out of control larger declines. All right, now my take on it. My take on it is that as long as the Fed playing field remains extremely dovish and there is nowhere else to put your money, then the stock market will likely continue to push higher or at least trade sideways. One thing that he leaves out of his article is the possibility of a rotation. So when you look at things that have been down since the pandemic started and are still down, so let's take a look at the JETS ETF, which tracks the airline stocks, right? This is currently trading at around 24 bucks, but it was trading above the $30 range before the pandemic. So if you are, say, heavily invested in Apple, or there's a huge amount of the market is invested in Apple, and Apple is seen by the market as being toppy or there being no reason for it to continue growing, well, then you start to see what's called a rotation where money flows out of the mega cap tech stocks into some of these cyclical stocks. So you don't necessarily have to have dry powder or cash on hand in order to make that rotation. You would simply take it out of one sector and put it in the other. So I think the article underrepresents that possibility a bit. However, when I do take a look at the S&P 500, for instance, I've said this before, but we normally get an average of 3 pullbacks a year, meaning a drop of 5% or greater. We have not gotten one all of 2021 until recently, until this month. So just logically, is the biggest drop in 2021 going to be a 5% pullback? I would struggle very hard to say yes. Now, could it be true? Yes, of course. In September, we saw a net outflow of money from stocks into fixed income funds, meaning funds that are based on bonds and treasuries. However, last week, as of the time of this recording, was the first time that we saw a net inflow back into equity ETFs, meaning stock market ETFs. The highest amount of money being attributed to the QQQ, which is the ETF that tracks the NASDAQ. And because we're not Nostradamus and we cannot pick the absolute bottom, when you see a stock market index or when you see a stock that is trading at a clear discount based on a set of criteria that you follow, you take that opportunity. So when the NASDAQ dropped 8% and was sitting at the 100-day moving average, we have no idea for certain if it's going to drop further. However, if you invested in the NASDAQ at the 100-day moving average over the course of history, and you did that consistently, then you would have significantly more money than you do today. We'll wrap it up with this quote and then we'll get into the stock picks, but you really need to drill this in your mind. This is from 1994, but it applies even more so today. So in this quote from 1994, he said, 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, and a one-day drop in the Dow of 508 points, or treasury bill yields fluctuating between 2.8% and 17.4%. But surprise, none of these blockbuster events made the slightest dent in fundamental investment principles. He finally ends this with, focus on the playing field, not the scoreboard. So it is very important when you're making investment decisions to know why you're buying what you're buying. Is it just because somebody on YouTube told you to? Is it just because your friend told you to? Or have you really looked at the company and you're like, I could see a case for why this company will be worth more in 10 years than it is today. Trading is a whole other discipline and ball game than investing. In this video, we're just talking about long-term investing. All right, so in order to fight inflation and hedge against any more downturn in the market, what should you do? Well, I did a whole video on how to hedge. It goes into detail about how to hedge mostly with options. Click that link here if you want to watch that. I think it's really valuable for you. But there are a few areas based on the current landscape that I would look into. I talked about a barbell approach to investing in mega cap companies, as well as investing in value stocks. Value stocks tend to do much better in high inflationary periods. Or you can invest in individual value stocks like Nike, Coca-Cola. Think of it's not isolated to retail, but if you're new to investing, think of marquee retail brands. Most likely, most of those will be value stocks. You can also throw in travel, leisure, and automotive into that category. All right, second thing, look at banks. Look at the ETF called XLF. But the reason that you want to look at banks is because of the current credit euphoria, as well as the fact that interest rates will rise in the next year, whether we're talking about bond yields because of tapering or the actual Fed interest rate itself. As a matter of fact, this next round of earnings in the next few weeks, as of the time of this recording, a lot of analysts are predicting that bank stocks will be the winners. And lastly, as Michael Burry is doing, you want to look at real assets because real assets tend to be really good hedges against inflation. Real assets include precious metals, commodities, real estate, equipment, land, water, etc. Per this article, more than half of Michael Burry's portfolio is currently dedicated to real assets. Here's an example of some stocks that track real asset investments. I will leave this link in the description below just for you guys to use as a reference, but you can Google this and study it on a weekend before making investment decisions. And the last thing I'll talk about is you definitely want to have a hedge against the market. Now, last week in the private trading group, we opened up a hedge on the VIX being the volatility index. So because the VIX dropped to the teens where it usually bounces from, we sold a credit put spread on the VIX in order to hedge against any volatility in our portfolios. If you want access to all of our trades, link is in the description below. Come be a part of a great trading group with over 4,000 traders. We talk stocks, options, crypto, strategies, etc. Would love to have you. Come join the community, be a part of the fruitful discussion. Anyway, traders, that is it for this video. I hope you got something out of this video. I hope that it at least gives you a little bit of a guide of what to look for in terms of the current market landscape and what it will look like in the near future. If you want access to all of the trades, link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.